It's been a long ride and it's almost over. But in the famous words of Yogi Berra, it ain't over till it's over. So in this session, I'd like to take a review not just for the final exam, but of the entire course. Along the way, we're going to see all of the ground we've covered and in the process look at some of the mechanics of what needs to be done. So let's go back to the very beginning. We started with corporate governance, and in corporate governance, essentially, there aren't that many issues to deal with other than the fact that there are obvious conflicts of interest. Conflicts of interest at every level between what the board of directors is supposed to do, which is protect shareholders, and what they actually do, which is protect managers. Managers, what they're supposed to do, which is to advance the interests of stockholders, and what they might actually do, which is to protect their own interests. I'm going to skip over the corporate governance section because I'll be revisiting old fights. I'd like to jump forward to the first meat and potatoes part of this class that we dealt with, which is betas. So let's start with some basic mechanics or issues with betas that I think we sometimes forget as we start to use betas. First, remember, beta is not a measure of risk. It's a measure of risk added to a portfolio. So when we use betas, we're implicitly assuming that investors are diversified, at least the marginal investors who set prices, and that the only risk they built into hurdle rates is the risk they cannot diversify away. You might say, well, what if that's not true? Remember, with private companies, we talked about adjusting betas for the additional risk. We came up with the notion of a total beta, which captures total risk. But when we're looking at publicly traded companies, we argue that the marginal investors are likely to be diversified, and therefore the risk we need to measure is the risk you cannot diversify away. Then we talked about how to estimate betas. We started with the conventional way of estimating betas. Run a regression of returns on the stock against returns on market index. The slope of that line, we said, was the beta. We also said there are the pieces of output to this regression that are useful. The intercept tells us how good or bad the stock was during the period of the regression. The R-squared tells you where the risk in the stock comes from, how much comes from market risk. We also talked about what it is that drives betas as we went through the process. We said betas don't come from regressions, they come from choices that companies make about what kind of business to be in. Businesses that are discretionary, products and services that are discretionary. Luxury retail, for instance, should have a higher beta than discount retail. We also talked about fixed costs and variable costs and how they can push up betas, having more fixed costs. And finally, we talked about how leverage can affect betas. But in the traditional approach of regressions, we pointed to the weakness of regression betas. They're backward looking because you have to use past returns. They're noisy because those betas come with standard errors. And you cannot estimate a regression beta for a division or a private company. So we presented an alternative approach, a bottom-up beta, where you start with the business of businesses that a company is in. You get the betas for being in those businesses, and that requires looking at publicly traded companies in each business, getting the betas, averaging out, and getting rid of the leverage effect, and then weighting those betas by business by how much value you get from each business. We said if you're in a hurry, you can use revenues, but if you can convert revenues into value, that's better. So if you think about the two processes, regression betas and bottom-up betas, I think I've been pretty clear about my biases. I prefer bottom-up betas because they're more precise. Incidentally, if you stay with the regression beta, remember, even if you trust the regression beta, to the extent that your leverage has changed over time, your debt to equity ratio has gone from 10 to 50%, you might still need to clean up that regression beta. In what way? You might have to unlever it to get rid of the 10% debt to equity that's embedded in there from the regression and put in the current debt to equity ratio. So that's the basic way in which we thought about betas and the alternatives. We talked about how actions companies take can affect their betas. With acquisitions, we said this is what you need to do. You need to compute the unlevered beta of the two companies involved in the acquisition, take a weighted average given their relative values, and then bring in the effect of leverage. How did you fund the acquisition? So three-step process. Start with the unlevered betas of the companies, weight them, and then re-lever basing the debt to equity that the combined company will have. With divestitures, we said you need to look at what you divested and the beta what you divested, and then look at the beta whatever's left over, because your company will then reflect the loss of that business that went away. You then also have to make a judgment on what you did with the cash from the divestiture, because you can leave the cash in the company, in which case you have an asset with a beta of 0. You can pay it out pay it out to equity investors, which can lower the equity and increase your debt to equity ratio. You can pay down debt, which will bring down the debt and lower the debt to equity ratio. But with acquisitions and divestitures or any corporate action, we talked about looking at the consequences for betas. So that's the basic calculation of beta, but that beta then goes into a cost of equity. The cost of equity, we said, starts with the risk-free rate. And that risk-free rate has to come from the currency of your choice. We said not the country in which your company is incorporated, plus a beta times an equity risk premium. The beta comes from a bottom-up beta, but the equity risk premium should reflect the country or countries you operate in. Let me very quickly trace back to the risk-free rate though. If you're asked to compute a risk-free rate in a currency where there is a default-free entity, and we use the cheating of AAA rated countries are default-free, we can use the government bond rate as a risk-free rate. US T-bond rate is the risk-free rate in US dollars. But if you're given a government bond rate in a currency where there is default risk, we said you have to clean up for that risk. By doing what? By taking out the default risk from that government bond rate so you don't end up double counting it once in the risk-free rate, or what you call the risk-free rate, and once in the equity risk premium. So the risk-free rate reflects the currency of your choice. The beta reflects the businesses you're in. The equity risk premium reflects the country or countries you operate in. So let's try this out. This is from a problem from a couple of years ago. Sumi is an all equity funded company. So file that away. I've just made your life a little easier. We'll talk about what if I'd not done that. Incorporated in Thailand, but it gets a large portion of its revenues in the US while operating in two businesses, steel and chemicals. I've provided both the geographic and the business breakdown in terms of value. So again, I've helped you out. We'll talk about what if that had not been the case, of how much value the company gets from each country and how much from each business. So if you look at the values of steel and chemicals, you're seeing essentially the breakdown of businesses. I've also given you the unlevered beta of the steel and the chemical businesses and the equity risk premiums of the two countries. I've given you a T-bond rate, and I've told you the Thai US dollar government bond rate. So file that away. It's a US dollar government bond rate is 4.5%. Ask you to estimate a cost of equity for the company in US dollar terms. There's a lot of data on this page. I'm going to let it sink in for a moment before I attack the problem. Okay, you ready? Let's start. What am I asking for? I'm asking for a cost of equity in US dollar terms. So let's start with the risk-free rate. It should be the simplest of the inputs. So let's get it nailed away. I wanted a cost of equity in US dollars. So guess what? I'm going to use the US T-bond rate as my risk-free rate. You're saying, why not the Thai US dollar government bond rate? Hey, the Thai US dollar government bond rate is not risk-free. How do we know? Because it's in US dollars and it's higher than the T-bond rate. So in this case, my risk-free rate is going to be in US dollars. Just as a what if. What if I'd asked you for a cost of equity in Thai baht? Well, the problem isn't complete then, right? Because I'd have to give you a government bond rate for Thailand. You're saying you gave us one, but I gave you a dollar government bond rate. I'd have had to give you a Thai baht government bond rate. And let's say it was 8%. What would you do next? The 8% is the government bond rate, but it's not default free, right? Because the government has default risk. So if you look at the default spread for Thailand, I've given you the information in this problem to compute it. If you go back to the previous page, the Thai government bond rate in dollars was 4.5%. The USD bond rate was 2.5%. That difference of 2% is the default spread for Thailand. If I wanted a risk-free rate in Thai baht, then I'd start with the Thai government bond rate, which would have had to be given, minus the 2%. So the risk-free rate is driven by my currency choice. My beta is driven by the businesses I'm in. I'm in two businesses. I give you the unlevered beta and the value of each business. It looks like I'm 80% steel, 20% chemicals. I take a weighted average. The weighted average of 1.14 becomes the unlevered beta for my company. Now, normally, I could not use this beta in a cost of equity because I'd have to lever the beta up. But if you look at the problem, I made your life easier by giving you the information that this company was unlevered. If you put in a 0 debt to equity ratio, my levered beta is going to be equal to my unlevered beta. I could have made this problem more complicated by throwing in some debt into the problem, in which case, what should you have done? You'd have had to compute a debt to equity ratio for the company and use the debt to equity ratio to come up with a levered beta. As we go through the session, I'd like you to constantly pause and ask, what if the problem had been stated differently? You can see the variance here. Let's talk about the equity risk premium. You're in two countries. I've given you the value you get from each country and the weights. I take a weighted average of those equity risk premiums. I come up with 5.75%. That cost of equity, risk-free rate plus beta times equity risk premium, is my answer to the problem. So break it down into pieces. Risk-free rate comes from currency, beta comes from business, equity risk premium comes from countries. Think about attaching value weights. You'll be off to the races. Let's move on from cost of equity to cost of capital. Equity is one way to raise money. I have a cost of equity, and that comes from looking at the risk I cannot diversify away beta and building it into a risk-free rate plus beta times risk premium. But there's another way I could raise money, which is debt. The cost of debt is the rate at which I can borrow money long term today. So don't get distracted. If I gave you the rate at which you could borrow money 2 years ago, 5 years, that's nice to know, but it doesn't help you. So to get my after-tax cost of debt, I need to come up with a rate at which I can borrow money today. And there are multiple ways I can do this. I can give it to you directly if I'm feeling kind. So as the cost of borrowing money long-term today is 7%. I can make it slightly more difficult, but not very much so, by giving you a rating and saying the company is rated BBB and a default spread for that rating. It's 2%, in which case you add the default spread to the risk-free rate to come up with the cost of debt. Or I could make things really messy and give you operating income and interest expenses and give you a lookup table to look up the synthetic rating. But one way or the other, you want to get a sense of how much it will cost you to borrow money today. Risk-free rate plus default spread. Incidentally, if you're in a country with default risk, you might have to have 2 default spreads added on. The Thai company that I gave you, to get a cost of debt for that company, you'd have to add the default spread for the company and the default spread for the country. Why? Because it carries country risk on its shoulders. To get the after-tax cost of debt, I have to multiply my pre-tax cost, the borrowing rate, by 1 minus the tax rate. And the tax rate should always be a marginal tax rate because interest saves you taxes at the margin. So if I give you both an effective and a marginal tax rate, stay with the marginal tax rate. So that's my after-tax cost of debt. I've got my cost of equity. The weights have to be market value weights. If it's a publicly traded company, equity is pretty simple. Share price times number of shares. And if you have multiple classes of shares, remember to include all of them. In theory, you should also include options, but no, hey, that's probably messy. So I'll be okay if you don't do it. Market value of debt is messier because most debt is not traded. So if I gave you bank debt or book debt, and I give you the interest expense on the debt and the maturity of the debt, well, you got to use that technique we used in class to convert into market value. And here's a very simple test to see whether you're on the right track. If your book interest rate, what you get by dividing the interest expense by the book value of debt, is roughly equal to the market interest rate, your book value of debt and market value of debt should be roughly the same. If your book interest rate is lower than the market value of the debt, then the market value of debt will be lower than the book value of debt. So basically, if you look at book interest rate of 3%, market interest rate is 4%. When I compute the present value, my market value of debt will be lower than the book value of debt. So work through those because I have a few problems in past exams where I've given you book debt to convert to market. Try to at least get the market value of debt for a couple of those examples. And if you're looking at a specific project, you got to be careful how you come up with debt ratios of the project. On some quizzes, I've actually told you that the project is going to be funded just like a business. But if you're not given anything, you're safer staying with the company's debt ratios rather than how an individual project is funded. So let's take an example. Here's a company publicly traded with a market value of equity of 900 million, 100 million interest-bearing debt. So I've given you all the inputs you need. In fact, I've computed your cost of capital. And then after you compute it, I say, you've forgotten something. And essentially what you've forgotten is that this company has lease commitments of 120 million for the next 10 years. So this is pre-2019. Accountants were doing the wrong thing by not capitalizing leases. I want you to capitalize them, treat them as debt. So I want you to tell me what will happen to the cost of capital when you do this. So let's step back. I give you a risk-free rate and an equity risk premium, 3% and 5%, and a marginal tax rate of 40%. So what do we need to do? We need to come up with new values for the debt. But if I do that, then even if I assume the cost of debt doesn't change, my cost of equity is going to be different, right? Because my cost of equity is a levered beta cost of equity. And if I change my debt, that cost of equity will change. So here's what I start with. I start with the existing debt ratio, the wrong debt ratio, which is $10 of debt for every $90 of equity, which gives me a debt to equity of 10 over 90. I unlever first I solve for the existing beta. The existing beta I solve for because I've given you a cost of equity. And with the risk-free rate and equity risk premium I gave you, the beta that you solve for works out to be 1.20. then I unlever the beta. By now, you should have levered and unlevered so many betas, this should be second nature to you. I'm taking out the effect of the existing debt, and I come up with an unlevered beta of 1.125. You'll see why I need that in a moment. Second step, I convert leases to debt. Basically, this requires you to take the lease commitments, 120 million for the next 10 years, and you discount them at the pre-tax cost of debt. The reason we use pre-tax is the lease expenses are pre-tax. And I get a present value of 927 million. Please, by now you should be computing the present value of an annuity using the annuity formula. Because if you have to take 120 million every year for 10 years and discount them back individually, it's going to take you a lot of time. So by now, I hope you've got the payment button on your calculator at least nailed down. Present value is 927 million. I'm ready to go. I first add the 927 million to the existing debt of 100 million. My total debt becomes 1027 million. So now I've got to re-lever the beta. Take the unlevered beta, and you see now why I had to unlever the beta first. And I re-lever it back up using the existing higher, or the new debt that I've computed, 1027. My levered beta is much higher, 1.89. I plug that back in. My cost of equity is 12.47%. Then to compute my cost of capital, I compute a new debt to capital ratio. So the debt to equity gets used in levering and unlevering betas. The debt to capital gets used in the cost of capital calculations. 53.2% or 29% debt, 46.71% equity. I take a weighted average of my updated cost of equity of 12.47% and my after-tax cost of debt of 3%. I come up with a new cost of capital. And this is the right cost of capital because I'm reflecting debt from the leases as debt, as I should. So when you do cost of capital, there are relatively few moving pieces. Just keep your eyes on the price. Your cost of debt is a cost of borrowing money today, and you've got to reflect the marginal tax rate. And to the extent that your interest expenses might exceed your operating income, you might have a problem. We'll come back and talk about that in a later part of the session. But this is your cost of capital. So once we got the hurdle rate, which is what the cost of equity and cost of capital were, nailed down, we talked about how do you decide whether an investment is a good investment. The right way to do this, of course, is to project out the cash flows, incremental cash flows in projects. And you have a choice. You can either compute cash flows before debt payments by looking at operating income after taxes and subtracting out capex and adding depreciation and subtracting out change in working capital. Or you can look at cash flows to equity, which are after debt payments. So you start with net income instead of operating income, and you also subtract out any cash flows associated with debt. Why does that matter? The discount rate you use will reflect how you computed the cash flows. If your cash flows are pre-debt cash flows, you discount those cash flows at the cost of capital. You subtract out the total investment in the project. You come up with the net present value. If that net present value is greater than 0, you accept the project. Or you could have computed an IRR. I've never asked for an IRR question in an exam because all it does is separates those people who've learned how to use the IRR button on their calculator from those people who don't. But if you did compute an IRR, you compare that to your cost of capital to make your judgment. You're saying, what would have been different if I'd used cash flow to equity? You'd have discounted them at the cost of equity and subtracted out only the equity investment in the project. Again, the rule is simple. NPV is greater than 0, you accept the project. You got to take me on my word on this one. If you do this right, your net present value should be the same, no matter how you approach the project. But if you do it wrong, all bets are off. But with cash flows to equity, you're computing the present value of cash flows to equity, post-debt cash flows, and subtracting out only how much equity you invest in the project. And your IRR can be computed here as well. And here you compare to the cost of equity. So that is if you're given the full-fledged project numbers. This is what you did with the Disney theme park or the Vale Iron Ore Mine, if you want to go back and review that. If you don't have full information, then you've got to take shortcuts. And here are the shortcuts. You can take the after-tax operating income for either a project or an entire company. You can divide by invested capital. And invested capital is based on book value. It's book value of debt plus book value of equity minus cash. So basically, it's what you've invested in your books. And you compute a return on capital. You compare that to your cost of capital, at least in a very broad sense. If your return on capital exceeds your cost of capital, you're making more than you should. You have a good project or a good company. Incidentally, you can convert that return spread into what's called an EVA by multiplying by the capital invested. Not a big deal. It doesn't add any information, but you're comparing return on capital to cost of capital. Here's the alternative. You could have taken the net income on either a project or a company divided by just the book equity in that project and compared that return on equity to the cost of equity. Again, two different ways of looking at a project, but they should lead you most of the time to the same conclusion. So let's take an example. You've been given the net present value, you've been asked to estimate the net present value of an investment. It's a 3-year venture. I'm kind of trying to keep your life simple by keeping the number of years low. The initial investment is expected to be $1 billion. It'll be depreciated straight line over 3 years to a salvage value of $100 million. So if I just pause there, billion to 100 million, that's 900 million divided by 3 is about 300 million depreciation each year. During the 3 years, working capital is expected to be 15% of revenues, and the investment has to be made at the start of each year. And who cares? You're going to see it affects the timing of the cash flows. And at the end of the 3 years, the working capital is going to be fully salvaged. Cost of capital is 8%, tax rate is 30%. And I finally tell you what the revenues and EBITDA are going to be for this project for the next 3 years. So let's compute the net present value of the project. Let's start with the revenues. You multiply that by that EBITDA percentage, you get the EBITDA. You subtract out the 300 million depreciation each year, because remember, you're allowed to do that before you get to operating income. Your operating income is 0 in year 1, 100 million in year 2, 300 million in year 3. Act like you get taxed on that operating income. That's key to getting cash flows to the firm, right? Of course, in year 1, you have no taxes because you have no income. Year 2, you have 100 million, you have 30 million in taxes, 30% of the income. In year 3, you have 90 million. Just as a what if in the first year your project had negative operating income? You have two choices. You can carry the operating loss forward and shelter your income in year 2. But if this is a project of a much larger company, you can claim a tax saving in year 1. So if nothing is specified, I just claim the tax saving in year 1 and move on. I've got the after-tax operating income. Before you heave a sigh of relief, you're not done yet. So you add back the depreciation. You subtract capex, and in this case, the capex is only right now. I mean, I could have had a problem. You have some capex now and some at the end of year 1, in which case I spread it out over time. And that last number of minus 100 is your salvage value. Now comes the working capital. Remember, it's 15% of revenues. 15% of $1 billion in year 1 is 150 million. Now you take 150 million, you show it in year 0. You're saying, why? Because you invest at the start of every year. The start of year 1 is today. You're saying, why is it only 30 million year 2? 15%, so if you take 15% of 1.2 billion, it's 180 million, right? You're saying, why isn't it 180 million? It's the change in working capital. I've already invested 150. I take the change from 150 to 180, which is 30. Year 2, it goes up by another 45. Again, the change. In year 3, I get back the entire 225 million. So working capital is a little tricky. It's a change that affects cash flows, and you got to take care of it when the project ends. I compute the free cash flow to the firm. I take the present value at 8%. I get a net present value of 16 million. What's the rule? If it's greater than 0, you accept the project, at least based on the cash flows. This is a good project. Just to clarify investment analysis, let's take another example. Let's say that you decide to quit your job, you become an Uber driver. You believe you can make about $12 an hour after taxes and vehicle maintenance costs, driving $800 a year. Let me pause right there. It looks like you can make about $9,600 a year, right? But you do realize that to be an Uber driver who gets 5 stars, you need a more expensive car. So first you've got to so you're planning to buy a car anyway, but now you've got to buy a more expensive car. And because you're running a business, you'll now be allowed to depreciate that car. And let's assume that depreciation is going to be straight line down to a salvage value. Your tax rate is 40%. Your discount rate is 8%. So basically, this is a messy question. I want you to estimate the annual after-tax income you will earn as an Uber driver. So if I'd stopped right after the first sentence, this problem would have been done, right? 9,600. The question I'm asking is, by throwing in this additional information about having to buy a more expensive car, have I made this a more lucrative job or a less lucrative job? Let's pause it. What do you think? Well, obviously, if you have to buy a more expensive car, even though you're getting depreciation on it, this is going to make your income less than 9,600, right? Because you got to take out the effect of the more expensive car. But here's the problem. That is a one-time cost. You got to somehow spread it out over time. So here's what I did. I started with the 9,600, which was a given. I computed the additional cost because I have a more expensive car. And here's how I did it. I took the cost of a car without Uber, which is I pay $15,000 upfront, but there's a salvage value of $5,000, and I looked for the annuity. So basically, we compute the net present value. So you'll have minus $15,000 today, plus $5,000 discounted back 5 years. My net present value of a car without Uber is minus $11,000. There's no depreciation I can claim. It's for personal use. You can't claim depreciation. With Uber, I have a $25,000 initial investment and a $4,000 salvage value. But now, because I'm running a business, I do also get some depreciation tax benefit. So here's what I had to do. I had to get the initial investment minus $25,000, discount back the $4,000 in salvage value at the end of 3 years. And notice that the car doesn't last as long because I'm driving a lot more. So I can't compare the net present values. They're not going to be, no, it's not apples and apples. And then I had to also count in the $7,000 in depreciation each year. So here's what the numbers will look like. I'll have minus $25,000 in year 1, plus $4,000 in year 3. And the simplest way to deal with depreciation is to recognize the effect it has on cash flows. And what's the effect that depreciation has on cash flows? The tax benefit, right? So if I take the $7,000 times 40%, I get $2,800 as a positive cash flow every year for the next 3. So here in sum is what I have as cash flows. Minus $25,000 in year 0, plus $2,800 in years 1 and 2, and in the last year I get plus $2,800 plus the $4,000. I discount them all back. I get a net present value of minus 14,608. Remember, you can't compute net present values over different lives, so I convert those two into annuities. My without Uber investment turns out to be about minus 2,900 a year. And my with Uber investment turns out to be minus 5,669 per year. You take the difference between those annual costs, that's 2,764. It's the additional cost I bear as an Uber driver because of the more expensive car and the fact that the car doesn't last as long. Netting out that number, I get an annual income of $6,836, which works out to about $850 an hour, which is barely minimum wage in much of the country and probably below it if you live in New York City. I'm not sure Uber drivers are doing this, but in a sense you have to, right? Because you drive more, your car has to look better, and then that additional cost has to be borne by somebody. You can't just ignore it till it happens. So take a look at this problem. In fact, in this problem, I was extraordinarily lax in how I graded. Here's the first thing I checked. I checked to see whether the answer you got was less than 9,600 or more than 9,600. In other words, I said, are you even using common sense? Because if you said that your income is going to end up at more than 9,600 after I've added this more expensive car and a shorter life, well, I don't care what your numbers told you, something's off. I love for the fact that your depreciation might not have been computed right. Essentially, I was looking for a sense of direction of how you were bringing in these additional costs into your analysis. Let's move on to the capital structure section. In the capital structure section, everything is about changing the mix of debt and equity and getting the right kind of debt. To change the mix of debt and equity, here's what you need to do. You can't leave the cost of equity and debt the same. The key is, whenever there's a change in debt ratio, you first need to unlever the beta. Remember how we did it early on, the first problem, and then re-lever it based on your new debt ratio. And you need to do the same thing for the cost of debt. You can't leave it fixed. You got to revisit that cost of debt. If your debt is much higher, you'll have a much higher interest expense. And if you were not given the cost of debt, you got to back into what the new cost of debt is. So basically, when you change the debt ratio, your cost of equity, when you increase the debt ratio, your cost of equity will go up, your cost of debt will go up. You also have to stop and make sure your interest expenses are not getting so high that you're losing tax benefits. So you have different cost of equity, a different cost of debt, perhaps even a different tax rate. Changing your debt ratio could lower your cost of capital or raise your cost of capital depending on how the dynamics play out. So when you do this calculation, you are implicitly assuming your operating income is unaffected and that all existing debt is refinanced at the current cost of debt. So let's work out how this with an example. It's a company where you're given the existing debt and equity, $400 million in debt, $600 million in equity, and the cost of each component. It's expected to generate $48 million in operating income next year and faces a marginal tax rate of 40% on income. So here's the question. If you borrow $400 million and buy back stocks, it's recapitalization. You believe you will double the pre-tax cost of debt. Estimate the cost of capital after the recap. You're given again the risk-free rate and the equity risk premium. Let's work out the numbers. First, the current cost of debt pre-debt. So if you go back and look, post-debt it's 2.4%. But because the tax rate is 40%, pre-tax it's 4%. The current beta, because you're given the cost of equity of 9.3% and you have a 3% risk-free rate and a 5% equity risk premium, is 1.26. So here's what I do to compute the new cost of capital. First, I compute the new debt, 800. New interest rate at that debt is 8% because the problem says that the interest rate will double. The new interest expense will be 8% of 800, which is 64 million. And here's where you got to be a little careful. Remember, the operating income is only 48 million. The most you can deduct for taxes is 48 million. So even though your tax rate is 40%, you're not going to get the entire 40% of 64 million. You're going to be able to get 40% of only 48 million. What does this mean? In effect, the tax benefit you're going to get is only going to be only 30% of the 64 million. That's the tax rate I'm going to use. The new equity, of course, is down to 200 because I bought back shares. Incidentally, I could have told you that I was going to pay a special dividend, same effect. I go back to I first solve for my unlevered beta. To solve for my unlevered beta, here's what I had to do. I had to start with the current beta and then use the existing debt to equity. Remember, it's $400 of debt for $600 of equity. And use the existing tax rate of 40%. I came up with a levered beta of 0.90. Then I re-levered it back up using the new debt to equity ratio of 400% and also the tax rate of 30%. My new beta is 3.42. My new cost of equity with those inputs, 3.42 beta, 3% risk-free rate, and a 5% risk premium is 20.1%. For my new cost of debt, I take the 8%, but I multiply by 1 minus 0.3, not 0.4, because I've lost some of my tax benefits. I get a 5.6% after-tax cost of debt. The cost of capital is 8.5%. The key in this problem is actually recognizing that your interest expense rose above the operating income and adjusting both your levered beta and your cost of debt for the fact that your tax benefits have been lost. So that's if the debt ratio changes. Let's take another example, just to see what happens when you have to do these buybacks and the cost of capital changes. What happens to the value of the company? Incidentally, if you go back and look at the page that I did, when your debt ratio changes and your cost of capital changes, in effect, you're saving money each year. There's a saving and financing cost. If you take those savings and treat it as continuing, then the present value of those savings is what your company value increases by. So you can compute the change in firm value by taking the change in the cost of capital. And then you have to decide how much of that change goes to especially if you're doing a buyback, how much goes to the people who sell back their shares and how much remains for those people who stay in the company. So in this particular example, here's what I'm going to do. The company is going to do. It's going to borrow 400 million and buy back shares. The cost of capital will drop to 8%. So I've given you the cost of capital before because it had no debt, the cost of capital after. There's no growth in savings. I'm making your life a little simpler. And the shares are bought back. I've given you the price for the buyback, of $10 per share, which is higher than the $8. My question is, what happens to the value per share for the remaining shares after the buyback? So let's do this a step at a time. Let's start with what the existing value of the firm is. Right now, the value of the firm is 8 times 125, which is $1,000. The current cost of equity is also the cost of capital, 9%, and the new cost of equity is going to be lower. So the old firm value is what I start with, 1,000. And remember, the savings are only on the old firm value. So I take the 1% of 1,000 is my savings each year, which is $10 million. And I take the present value of those savings using an 8%, the new cost of capital. Incidentally, if there were growth, you'd put in that growth rate into the denominator. I come up with $125 million as increase in value. I add the 125 to the 1,000. I give you 1,125 million as my firm value. I subtract out the debt, I get a value for the equity. I divide by the shares outstanding. I get a value per share for the remaining shareholders, 853. Saying, how come they got gypped? Because I paid too much on the buyback. The price went up for them, but not by as much as it did for those people who bought back the shares. Take this problem and ask different what-if questions. Try different buyback prices. In fact, solve for the rational price. And the rational price, you know what I would do? I'd take the 125 million and divide by the total number of shares, the 125 million shares, which would mean that everybody gets an extra dollar per share. If I pay exactly $9 per share, everybody in this company will get exactly the same share of the spoils. So try that out. It's a good way to see what happens when value changes. Let's move to the last two pieces that we haven't covered on any of the quizzes. The first is dividends. And on dividends, there are two basic questions. How much did my company return to its shareholders? And I can look at dividends and buybacks. And how much could it have returned? And I compute a free cash flow to equity. Free cash flow to equity is cash left over after every conceivable need. Incidentally, it's the same free cash flow to equity we talked about in the context of a project. And once I make that comparison, I ask how much do I trust the management of the company? And to make that judgment on trust, I look at your past performance, both in taking projects. Remember how we looked at whether a project was a good project or a bad project, and how well the stock has done by looking at the returns your stock has made relative to the market and relative to the peer group. So let's try a simple example to see how this will play out. You have a publicly traded company, revenues of $250 million in the most recent year. The company has total working capital of $35 million and a cash balance of $25 million right now. So I've given you my estimates of revenues, and it's going to change dramatically over time. So it's going to go to $750 million next year, $1 billion. So you see my projected revenues and my net profit margin. Net profit margin is net income divided by revenues. The company plans to keep its non-cash working capital as a percentage of revenues constant for the next 5 years. Remember, I gave you the total working capital of $35 million and a cash balance of $25 million. Non-cash working capital then is $10 million. So you got to net the cash out. And also it plans to return no cash in years 1 and 2, pay out 40% of net income as dividends in years 3 to 5. My question is, how much will your cash balance be at the end of year 5? So let's start at the top. Revenues were given, so projected out. You multiply by the net margin, you have net income each year. The change in non-cash working capital is computed by taking what it is right now. Right now it's 10 million on 250 million, so it's 4%. And keeping 4% of revenues each year. So 4% of 750 million in year 1 is 30 million. The change in working capital, again, the same principle we applied with projects, is what I subtract out. So 10 to 30 is 20. I subtract out 20. And I do 4% of revenues each year, and I subtract out the change in non-cash working capital. I get my free cash flow to equity every year. It's minus 5 million in year 1. What does that mean? I can't pay dividends. I've got to raise 5 million in new equity. Plus 20 in year 2. Plus 14. Remember, each year where I have a free cash flow to equity and dividends, I can compute the change in the cash balance. But first I compute the free cash flow to equity. And then I compute the dividends based on the information given in the prompt. To compute my cash balance, here's what I do. I start with the 25 million. And in year 1, I look at the free cash flow to equity. It's minus 5. The dividends is 0. So basically my difference is minus 5 and reduce my cash balance by 5. In year 2, I have free cash flow to equity of 20 million. I pay no dividends. My cash balance jumps by 20 million. In year 3, my free cash flow to equity is 40 million. I pay out 19.2 million. My cash balance increases. So each year I look at the difference between the free cash flow to equity and dividends and adjust my cash balance. At the end of year 5, my cash balance is 143.3 million. Take this problem and you can change it in lots of different ways. I could have given you the cash balance at the end of year 5 and ask how much they pay out in dividends. So essentially, I can give you 2 of the 3 variables here, free cash flow to equity, dividends, and cash balance. And you'd have to back out the third one. There are only so many variations you can have on the dividend problems. If you understand the basics of free cash flow to equity, you're going to be pretty safe on the dividend problems. Finally, let's talk about valuation. Again, repeating what I said when I did the project analysis, when you sit down to do valuation, you first have to decide whether you want to value the equity in the firm or the entire firm. If you're valuing equity, you can discount cash flows to equity, or more strictly, if you just give it dividends, dividends is the cost of equity. And that cash flow to equity will grow over time at how much you retain, your retention ratio. It's 1 minus the payout ratio times your return equity. So essentially, when you're doing equity focused valuation, everything's equity based. Your cash flows are to equity, your discount rate is the cost of equity, your growth rate is growth in equity income, which is computed with return on equity. When you're valuing the firm, the same process applies, but everything is defined from the context of the firm. Your cash flows are cash flows before debt payments, cash flows to the firm. Your discount rate is the cost of capital. And your growth in operating income is what you're focusing on, because this is a pre-debt earnings. And to compute that growth in operating income, you're going to look at how much the company puts back into the business. And here you're computing how much of the after-tax operating income goes back into the business, and then what kind of return on capital you're making. Notice how terms we've already used in capital budgeting and investment analysis are back in valuation. Valuation is just an extension of capital budgeting. So let's try a final example. You're trying to value a company and you've been given the cash flows. So I've actually given you the free cash flows every year and the growth rates. After year 3, the company is expected to be a mature firm growing 2.5% a year in perpetuity with a cost of capital of 8%, which is lower than the cost of capital for the next 3 years. Finally, I tell you the company is going to earn the same return on capital as it did in years 1 to 3, at which point you're saying, you didn't give me a return on capital, did I? Well, we're going to see that it's hidden there. And the question asks you to estimate the terminal value, the value at the end of year 3. I'm actually going to do that and compute the value today, just in case you run into a problem where you're required to do that. So let's start with what you're given. You're given the free cash flows to the firm every year, right? And if you look every year, it looks like I'm reinvesting 60%. If you don't believe me, here's the way to do it. Take your free cash flow to the firm and divide by your after-tax operating income. 40 divided by 100 is 40%. 43 divided by 107 is 40%. In fact, every year, it looks like my free cash flow to the firm is 40% of after-tax operating income. You're saying, so what? Well, if my free cash flow to the firm is 40%, my reinvestment rate is 60%. Incidentally, I'd have got the same answer by taking capex minus depreciation and divided by after-tax operating income. You're saying, so what if the reinvestment rate is 60%? Remember my growth rate was 7.5%? If my return on capital is stayed stable, which is what the problem states, if I give you the growth rate and the reinvestment rate, you can back out the return on capital. Growth rate divided by reinvestment rate, and I get 12.5% return on capital. That is key to completing the problem. Because here's what happens after year 3. My growth drops to 2.5%. So that's the bad news. But the good news is, if my return on capital is 12.5%, and I'm now growing at 2.5%, I need to reinvest only 20%. So to get my free cash flow in year 4, here's what I do. I first take my after-tax operating income in year 3, 124.23, and grow it out 1 year at my stable growth rate of 2.5%. My growth rate drops, I've got to reflect that. But then I subtract out only 20% from that. You cannot take your free cash flow to the firm in year 3 and grow it out at 2.5%. It's going to give you a much lower terminal value than you should be getting. You need to compute the new reinvestment rate. With that free cash flow to the firm and putting in the new cost of capital, because now the cost of capital is dropped, I come up with the terminal value of 1852. Now in this problem you are done, but let's suppose the problem had asked you for what the value of the operating assets is today. Here's what you need to do. You need to discount your free cash flow to the firm each year for the first 3 years at a 10% cost of capital. You're saying that's not tricky. Then you'd have to get the terminal value, which is still, remember, at the end of year 3, and bring it back to today. And you'll have to use the 10% cost of capital to discount it back. And that confuses people because they said, look, you computed the terminal value using an 8% cost of capital. Why are you switching back to the 10%? Because you got to live through the 3 risky years to get to your terminal value. The key in the terminal value calculation is first recognize, even though I'm using the cash flow in year 4, I'm getting the terminal value at the end of year 3. So I've got to discount it back 3 years. And second, recognizing I've got to discount back at the cost of capital I had for the first 3 years. That's the value of my operating assets. In fact, if I'd given you debt and cash in this problem, you know what you'd need to do, right? You'd need to add the cash on because it belongs to you as an equity investor. You need to subtract out the debt because you owe it to get to value of equity. So the valuation prompts first look at the numbers, the inputs, to see if you've been given equity numbers or firm numbers. Then look to see what information you're given, because I'll have to give you information about 2 of 3 things. Information about growth and reinvestment or growth and return on capital. Because if I give you 2, the third one can be computed based on that simple equation. Then at the end of your growth period, make sure that when you compute your terminal value, you do a year 4 or a year 6, depending on whenever your growth ends, explicitly, by factoring in what the return on capital is going to be at that point in time and what your growth rate is going to be at that point in time. Try a few of the past problems, because in every one of these problems, you'll see this process play out. But that's the valuation part. In fact, I've summarized on this page how similar the different discounted cash flow models are by looking at the dividend discount model, a free cash flow equity model, and a firm. It looks incredibly confusing, but go across and you're going to see how much we do in common. All we're doing is changing the way we define cash flows, changing the way we think about estimating reinvestment and how good our projects are, but ultimately the end game is still the same. So that's pretty much everything I wanted to say in this review session. And I think we've covered pretty much, again, everything we've done in this class. So if you found any parts of this confusing, you might want to go back and revisit that section of the notes, or look at a prior quiz. But again, focus in on the problem in front of you. Don't try to jump ahead. The final exam is 2 hours, so you have the luxury of doing one problem quicker so that you have more time on another problem. So take advantage of the time you have. Thank you.